I welcome all of the students for today's class, and in this class we are going to discuss about bond returns and risks. Now let us see the lecture objectives. To know the risks involved in bonds, to understand the returns of bonds. Finally, the lecture outcome is to aware about the risks of bonds investment and able to understand the returns of bonds. Now, bonds as an investment tool are considered as safe. Of course, there are many investment alternatives are available, but out of all these investment alternatives, bonds are considered to be the safest kind of investment. However, no investment is out of risks. So, there is also a type of risk that is involved even in bonds also. Now, in this class we are going to discuss about those risks that are associated with the bond investment. And risk averse investors never invest during intermittent period of slowdown. So, normally people those who are not in a position to take more risk, so they do not involve in kind of investment when there is a slump, because most of the opportunities arise in the market whenever you enter into a place where there is a great scope for the investment. But risk averse investors never invest their money in slumps. Okay, so that is also one of the aspect. But the risk loving investors, so risk takers, take such kind of incidents of slowdown in a positive way with the expectation of gaining significant return over time. So, because let us consider the corona pandemic situation wherein the markets have came down for about 30%. So, some of the investors have taken it as an opportunity, and they have invested their money in during those times. And again, the markets have bounced back, and now they are in good profits. So that's what. So risk takers always take those kind of opportunities, those kind of incidents as opportunities, and make investments and gain over time. So, hence, it becomes imperative for us to understand various risks that are associated with bond investments and to what extent that they can affect our returns. So, in this class, that is why we are going to discuss about what are the returns and what are the risks associated with the bond investment. Now, on the screen you can see there are a lot of risks that are associated with the bond investment. So, these are all the risks that are associated with the bond investment, starting from inflation risk, interest rate risk, call risk, reinvestment risk, credit risk, liquidity risk, market risk, default risk, and even credit risk. Now, credit rating risk. So, now let us discuss about these risks one by one. Now, let us discuss about what is inflation risk. Inflation risk is also known as purchasing power risk. So, this inflation risk refers to the effect of inflation on investments. So, inflation means what? The rate at which the prices of goods and services increases year on year is called an inflation. So, how it is going to affect our investment is, let's say for example, you have invested your money into a savings bank account. The savings bank account normally gives you an interest rate of 4% or 5%. But say for example, the inflation rate prevailing in that particular country is say 6%. Now, the 4% or 5% which is less than the inflation rate. So, over a period of time, the prices of goods and services increasing at a rate of 6%, but whereas your investment gives you a return of only 4% or 5%. So, you are lagging behind the inflation rate. So, that is why that is what is known as a risk associated with the inflation. So, even bond returns also sometimes you know if you by the time you invest your money, in case if the interest rates are very less, then probably sometimes your inflation rate may go higher than the return that you get it out of the bond investments. So, that is why the inflation risk or purchasing power risk also may exist in the bond investments. Next one is a interest rate risk. So what is called an interest rate risk? So every bond is associated with offering in interest amount. So zero coupon bond will give you the interest in the form of discount, but whereas coupon bonds give you regular interest amounts. So what is called an interest rate risk? An interest rate risk is something when you invest your money in bonds, then probably by the time you invest your money in the bonds, the interest rates may to some extent. But after you make an investment, your into the bond investment, then say for example the interest rates have increased. Now you have given money or invested your money into bonds, say 6% interest rate. Now say the interest rate in the market now increase it to 7% or 8%. Now the interest rate risk is affected you, because right now you are getting only 6%, only sorry 5%, but right now the market is giving us a 6% interest rate. So this risk is known as interest rate risk. So the change in the interest rates in the market may affect your bond investment and accordingly the returns of the bond. So this kind of risk is known as interest rate risk. Now, the next risk is call risk. Call risk is specifically associated with bonds that come with an embedded call option. So, which is nothing but a callable bonds. So, a callable bonds means there is an option for the issuer to call back the bonds which are already issued at any time, or maybe a specific time that is already mentioned while issuing the bond itself. So, if they exercise that particular option, then probably you may not hold the bond until the time it expires. So, in between the time, the bond issuer may call back the bonds and close the bonds. So, such a case, again you need to take the money and you have to go for a reinvestment. So, call risk means that. So, there is a possibility that the issuer may call back your bonds at any point of time, and by the time you are supposed to make out of your investment into bonds. So such kind of risks are known as call risks. So such investors are however compensated by high coupons normally, because there is an option, call option, that is embedded in the call, call bonds. So that's why they may give you higher coupons while issuing the call options. And then reinvestment risk. A reinvestment risk is the probability that the investors will not be able to reinvest the cash flows at a rate comparable to the bond's current return, refers to the reinvestment rate risk. Say for example, you have made an investment into a bond wherein you are getting 7% return per annum, and the tenure of the bond is say 5 years. Now, after making an investment into this bond, now you have taken back your investment at the in between this period, let's say at the end of third year. Now, once you take back your investment back, then if you want to invest your money into again bonds, during this time the interest rates may change. So, you may not be able to get such an amount of interest which is already been achieved earlier. Now, you may not achieve that particular interest rate percentage. So, this risk is known as reinvestment. So, from investment to investment, the interest rates may change, and that may pose you this kind of reinvestment risk. So, this tends to happen when market rates are lower than the bonds coupon rate. So, normally this kind of interest rate, in reinvestment risk is faced by the bond holders. When market rates are lower than the market bonds coupon rate. Now, what is called a credit risk? Credit risk results from the bond issuer's inability to make timely payments to the lenders. So, normally the bond holders will get periodical interest payments. In case if bond holders, whoever have issued the bonds, if they are not in a position to pay you the interest amounts on the regular terms, so then you are supposed to face this particular credit risk. So where it leads to the uninterrupted cash flow for the lender, so where the losses might range from moderate to severe. That's why credit history and capacity to repay are the two most important factors that can determine the credit risk. So before making an investment into bonds, you need to check whether the issuer is having the capacity of paying you the interest amount on regular terms or not. So that's how you can minimize the credit risk. But credit risk means the inability of the issuer for paying the interest amount. Next one is a liquidity risk. So liquidity risk, the ease with which we can convert the asset into cash is called liquidity. So now liquidity risk arises when bonds become difficult to illiquid, the difficult to liquidate in a narrow market with very few buyers and sellers. Say for example, bonds are already listed in the, can be listed in the market, stock market. If the players in the stock market are less for certain kind of bonds, then probably you might, you may or may not get the right buyer or right seller for the bonds. In such a case, you will face the liquidity risk. So you may not be able to sell off your bond as soon as you want, or you may not be able to buy the bond as an or whatever the price that you prefer. So these are all called as the factors related to the liquidity risk. So narrow markets are characterized by the very low liquidity and very high volatility as well. So this is also one of the risk factor for the bonds. And then market risk or systematic risk. So any investment is subjected to this particular risk, market risk. And market risk is the probability of losses due to the market reasons like slowdown and changes in the rates as such. So market risk affects the entire market together. So depending upon the market factors, so your the investments might change. Your investment might affect. So such a kind of risk is known as a market risk. So in the bond market, no matter how good investment that you make it, but it is bound to lose value when the market declines. Certainly, even the bond is a very high, credit rating, bond. But again, when market risk poses, then your bonds also are going to suffer. So such a kind of risk is known as a market risk. So interest rate risk is another form of market risk. Yes, interest rate risk is also a kind of market risk. So wherein the change of interest rates in the market might affect your investment. And the next risk is default risk. So default means the bonds are exist, mean a contract agreement between two parties, a borrower and a lender. So when an agreement happens between these two parties, borrower and lender, and there may be a default from the borrower side. So means default in the case default of paying the principal amount, so at the end of the period, or else default in paying the interest amounts on regular intervals. So default in the sense they may not be able to, or an inability to pay the principal amount back. So that is what a default risk. So bond issuing company must have the such a kind of assets and all collateral to avoid this kind of default risk. Otherwise, the bond holders are supposed to face this kind of default risk. And then rating risk. So SEBI through its regulations, it has mandated the issue of bonds with a credit rating. So bond investments can also sometimes suffer from rating risk. So where a slew of factors specific to the bond as well as the market environment affect the bond rating and thus decreasing the value and demand of the bond. So certainly credit rating agencies issues the rating for a particular issue depending upon different factors. So by the time the bonds are being rated, the several factors which the credit rating agencies are going to consider might favorably impact your company or may not be favorably impact the particular bond issuer. So where in case if the rating is, if the rating goes wrong, then it will adversely affect the bond issue and the demand for the bond as well. So that kind of risk is known as the rating risk. So far we have seen the risks of bonds. Now let us observe what are the returns of bonds. So the natural and very frequently discussed about the return of a bond is a yield. So what is called a yield? Yield is a general term that relates to return on the capital that you invest in a bond. So how much return that you achieved when you make an investment into a bond is called a yield. There are several definitions that are important to understand when talking about the yield. It relates to bonds like coupon yield, current yield, yield to maturity, yield to call and yield to burst. Now let us discuss about first coupon yield. What is meant by a coupon yield? So coupon means it's the rate of interest that is paid on the bond. So coupon yield is the annual interest rate established when the bond is issued. It's the same as the coupon rate and is the amount of income you collect on the bond, and normally it is expressed as a percentage of your original investment made in the bond. Let us say for example, if you buy a bond for rupees 1000 and you receive $45 in the as an annual interest payment. So then your coupon yield is going to become 4.5%. So this is what we call it as a coupon yield. Now, what is called a current yield? So, current yield is the bond's coupon yield divided by its market price. So, how much your yield depends on the current market price. So, that is calculated by the current yield. So, now you can calculate the current yield depending upon the market price of the bond or a trading price of the bond. So, for example, in this scale, coupon yield of a particular bond, what we have discussed in the previous example, is 4.5%. Now, say for example, the bond is trading at 103 rupees, oh sorry, $103. So then your bond in your current yield going to become what the coupon yield divided by the market price of the bond multiplied by 100. So that gives you 4.37% is the current yield. And then yield to maturity. So yield to maturity is the overall interest rate that is earned by an investor to who buys the bond at the market price and holds it until maturity. So now you have purchased the bond and you hold this particular bond till the maturity. If you hold the bond till the maturity and you purchase the bond right now from the market, then how much yield that you are going to achieve is nothing but a yield to maturity. So mathematically, it is the discount rate at which some of the future cash inflows, it is also expressed and calculated by considering the time value factor. And it is often quoted in terms of annual rate and may differ from bonds coupon rate. And it assumes that coupon and principal payments are made on time. So the main assumption for the calculation of yield to maturity is so when all the principal payments and the coupon payments are paid on regular times, and it does not require the dividends to be reinvested, but computations of yield to maturity generally make that assumption. Means whatever the yield, whatever the interest amount that we are going to receive here, that is reinvested, is another assumption. It does not consider taxes paid by the investor or brokerage costs associated with the purchase while calculating the yield to maturity. The next one is yield to call, YTC. It is figured the same way as yield to maturity, except instead of plugging in the number of months until the bond matures, you use a call date and the bond's call price. So call date is nothing but at what time the issuer may call back the particular bond. Though the call of a particular bond may actually be happen or may not be happen, but the yield to call is going to calculate the value of the yield till the time of the call period or call time. So, this calculation makes the sense for the bond holder in case the bond issuer exercise the call option, then what would be the yield to, till the call, so will be calculated. And yield to worst is whichever the bonds YTM and YTC is lower is called the yield to. So, we have calculated yield to maturity and also we have calculated yield to call. So, some bonds may have yield to maturity may be high, some bonds may have yield to call may be high. So, depending upon the yield to maturity and yield to call, you must be in a position to take a decision whether to go for a bond investment or not. So, then you will go for a yield to worst. Then for each and every bond, you will check which one is the best, whether yield to maturity is the best, whether yield to call is the best for going into this kind of bond investment. Then comparably you will take a decision whether to go for what kind of bond. And yield reflecting broker compensation is the yield adjusted by the amount, the markup or commission when you purchase, or markdown commission when you sell, and other fee that are charged, that you are charged by your broker for its services. So, simply the yield reflecting the broker compensation is the yield, means all broker compensation, other hidden charges are also taken into consideration and calculating this yield. And this what yield curve, this is what upward sloping. You can see here on the left hand side you will see the yield, and on the right hand side you will see the maturity. So, from the yield to maturity you can see the upward curve for the yield to maturity, the yield that happens in the bond. This diagram is known as yield curve. The last concept is bond return. So, how much return that you are going to get out of a particular bond also can be calculated as one of the return measure. So, which is nothing but end value of the principal plus coupon interest payment plus compound interest, because the interest is assumed to be reinvested, and then minus taxes, fee or commission that is payable, and whole minus divide beginning value of the principal divided by the beginning value of the principal multiplied by 100. So, this will give you the bond return, and finally after considering all the taxes and commissions and all other factors, so how much return that you are going to get, it will be calculated in this way. So, this was a disclaimer. So, thank you very much for participating in this class.